exam 1 and 2 concepts to review for exam 3. So there's 10 questions here. We're going to take a look at these 10 questions. The idea here is on exam 3, there's going to be some concepts you need to know from exam 1 and 2. Now, these are departmental questions. I don't have any, I did not design these questions. I want to make sure, though, that you understand that what we learn in this class applies all those questions. There might be a few little tricks, or it might be given to you in a different way. So that's what this video is really meant for. So the first question, go back to Module 2, Discussion Problem 4. And just focus on specifically the amount of gain recognized by Lemon. So if you remember in Module 2, Discussion Problem 4, we're talking about Section 1031, like-kind exchanges. We had lemon and lime, and I actually provide you with the question. Here it is. We have lemon and lime. Lemon owns a building used in his business or investment activity. Makes no difference. Lemon's building is worth $800,000 and it has an adjusted basis of $500,000. He exchanges the building for another building owned by Lime. Lime's building is worth $700,000 but is subject to a $200,000 liability. Lemon assumes a $200,000 debt and uses Lime's building in his business after the exchange. Also assume that there's a $100,000 liability associated with Lemon's building that Lime assumes. Finally, Lime pays Lemon $200,000 cash. How much gain would Lemon recognize, and that's what we're focusing on this transaction. Now again, just focus on what the question's asking. Yes, I know when we covered this before, we focused on realized gain, recognized gain, basis, holding period, all these different issues. We're just focusing on the gain recognized by Lemon. So first thing to remember is any property transaction, you're going to have amount realized minus adjusted basis. And remember, amount realized, the way to determine that is going to be actual cash received by Lemon. Remember, we're looking at Lemon here, not Lime. Actual cash received plus liability relief or constructive cash plus fair market value of non-cash property minus selling expenses. So go through this problem. If you want to pause the video or take a look at it, that's fine. But I actually have it broken down for you already. So there's there is an amount realized here. I've calculated. We take the $700,000 fair market value of the building plus the $100,000 liability relief on Lemon's building that Lime takes on plus $200,000 that Lime pays Lemon minus, my apologies. That is our amount realized. Those three items. There's no selling expenses. So if we add together those items, right, the fair market value of non-cash property received, the liability relief, which is $100,000, and the cash received by Lemon, we get an amount realized of $1 million. The adjusted basis of property given up, that includes all property given up. So again, amount realized is what you're getting of economic value. Amount or adjusted basis is what you're giving up. So Lemon here is giving up two things. Lemon's giving up a building with a basis of $500,000, but also taking on a liability. And the liability taken on is a $200,000 liability on Lime's property. So we add those two together and we get $700,000. So the adjusted basis in this calculation is $700,000. So that gives us a realized gain of $300,000. The next step, we've got a realized gain of $300,000. Under the tax law, section 1001C, all realized gains and losses must be recognized unless there's a non-recognition rule. We've got 1031 like-kind exchanges. Remember, if you have real property that's traded for other real property. Real property is land and everything attached to the land, so land and buildings. And on both sides, that taxpayer, Lemon here, right, is going to hold the property as business or investment on both sides. And we're told that in the problem. Lemon gives up business or investment and gets business or investment property. That's key. Then you qualify for like-kind exchange non-recognition treatment. Now, The key, though, is if you receive anything other than that property that qualifies, you might have to recognize gain to the extent of boot, but never loss. So that's what Lemon has here, because Lemon receives liability relief and also cash, which are not considered real property. So we got a $300,000 realized gain, and we also have boot. The issue with the boot is we've got Lemon receives $100,000 of liability relief and also $200,000 of cash. Now, when it comes to liabilities taken on, or when it comes to boot, the general rule is you're allowed to offset boot paid with boot received. But there's a special rule for liabilities taken on. You can only net liabilities taken on with liability relief. So that $200,000 that Lemon takes on Lime's property, we net that with the liability relief boot, and we get negative $100,000. However, you're not allowed to use this $100,000 on other boot received. We can't use this. So we actually treat it as zero liability relief. Why? Because we have enough liability taken on to offset it, but we're not allowed to use the negative liabilities taken on to offset the other boot. So what does that mean? The only boot received here by Lemon is $300,000. Okay, the question is asking just for the recognized gain. Easy. No basis, just recognized gain. And the rule is when you have boot, it's the lesser of the realized gain, which here is $300,000, and the recognized gain, recognized gain, and the boot. And we just calculated the boot. The amount of boot is the $200,000 cash because the liability relief offset itself, right? So the lesser of the two is the $200,000, and that is the amount of gain that Lemon recognizes as $200,000. Okay, problem 2. So problem 2 comes from module 3, discussion problem 6. And you might be reading this module 3, problem 6 later, and I might have already adjusted the language. But we're focusing specifically on the part of the problem. He sold equipment held for business purposes for $20,000. He originally purchased equipment for $15,000, took $9,000 depreciation on the equipment over time. Let's rephrase it. What if we have Raspberry? Raspberry sells equipment used in business for $20,000. He purchased it many years ago for $15,000. While holding the asset, he took $9,000 of depreciation under makers. He also took $9,000 of depreciation under straight line method. So the fact that there's makers and straight line depreciation is irrelevant. We can pretty much ignore the straight line depreciation for financial accounting purposes because we're doing tax. This is a tax issue. So we just focus on what was taken for makers, which is what you use for tax, right? So I just crossed that out. So this question is asking how much gain should he recognize in the transaction and what's the character? All right, so the first part, we do amount realized minus adjusted basis. So amount realized is what you're getting. So here Raspberry is going to get $20,000, right? Cash. He's selling. Sale is cash. So $20,000 is what he's selling for. He purchased it many years ago for $15,000. While holding the asset, he took $9,000 of depreciation. So if we calculate the basis, the adjusted basis, right? Think about it. The unadjusted basis is when he acquired it. That's the cost basis. That is the $15,000. We subtract away the $9,000 depreciation, tax depreciation taken. The adjusted basis is $6,000. This gives us a realized gain and recognized gain of $14,000. Why recognized? Whenever you sell for cash, always non-recognition, because remember the two tax themes, liquidity and economics, those are not present, so you're going to have to recognize the $14,000 gain. It's both realized and recognized. So that's part of the question, how much gain should you recognize? $14,000. So if you have a multiple choice question, you're looking for an answer choice that adds up to $14,000. So now we go to characterization. So in general, the characterizations are capital, and ordinary. Those are the options. With respect to capital versus ordinary, to get it, general rule, to get a capital gain, you need to have a capital asset and a sale or exchange. Do we have a capital asset? No. Because in our capital asset list, right, the assets we learned that are not considered capital assets like inventory, supplies, accounts receivable, certain intellectual property, which isn't intellectual, it's equipment. But also in that group, any business real property and any business personal property subject to depreciation and amortization. He's selling equipment used for business. Business is a depreciable asset. He actually depreciated it. So that means this is not a capital asset. So you're saying, okay, well, if it's not a capital asset, then it's going to be ordinary income. Generally speaking, that is how it works. But there are exceptions. One exception is Section 1231. If we hold the property for more than 1 year, right, and it's business property, subject to depreciation and amortization, or even real property, but not inventory, which we have that here, right? And also a sale or exchange. We need a sale or exchange. We have that as well. Business property, other than inventory, has to be depreciable, amortizable. Basically, it's the two items from the capital asset list, right? Those two classes, right? Personal property subject to depreciation, amortization, or business real property. Has to be one of those two. So if we have that, then the gain counts as Section 1231. However, there's a rule that trumps Section 1231, and that's Section 1245. If you have personal property that's been, or my apologies, yes, personal property, right? So intangible or tangible that's been depreciated or amortized, you have to do the lesser of the realized recognized gain, which here is the same. So I'll put realized recognized gain, but it's realized recognized, or the depreciation taken. So here we have a $14,000 recognized gain. How much depreciation was taken? $9,000. So what's the lesser of the two? The $9,000 depreciation. So of this $14,000 gain, $9,000 is Section 1245 recapture. And by the way, we know depreciation's been taken, right? We're told $9,000 of tax depreciation. And then for 1231, that's the remaining portion. Why? Because we're not told how long. I'm sorry, we are told. My apologies. We're told that they acquired it many years ago, but you also can tell by the amount of depreciation. So the remaining portion, the remaining $5,000 of gain is Section 1231 gain. And remember, Section 1245 recapture is always treated as ordinary income. And that's it for problem 2. All right, let's go to problem 3. So problem 3 comes from Module 6, discussion problem 2, just like the question we did. It's just going to focus on how much gain does Cantaloupe recognize and what basis does Mellon Corporation take in the supply. So 2 parts of the question. So here's the question again. You got Cantaloupe, Honeydew, Watermelon. They organized Mellon Corp. They each received 20 shares of stock. Now this is what they give up. This is what they give up. Cantaloupe gives up supplies with a value and adjusted basis. Honeydew, Watermelon give up cash. Now, in addition to receiving stock, so Honeydew, Watermelon, they only receive stock. Cantaloupe also receives a promissory note for $200,000 due 10 years, and the value of that note, based on what we're given, is $200,000. Now, on the exam, if you're just told a note, we always assume the value of the note is what it is at the face value. Okay? Just for purposes of the CPA exam, my exam, that good stuff. So some of you are wondering, well, this is boot. Why isn't it liability relief? Well, liability relief is when you take out a liability on property and the corporation takes on the liability with the property. That's not what we have here. This is basically the corporation saying, I'm going to pay you $200,000 in the future, a future right to money. And that's why this is considered just straight $200,000 of boot. So, if you remember, right here, this problem, we've got a Section 351 issue, right? And we're only focusing on Cantaloupe. So the amount realized and adjusted basis, which I give here, Remember, any property transaction. What's the property transaction here? Cantaloupe is exchanging supplies for stock and a note. That is a property transaction. So the Section 1001 amount realized is $450,000, which is the value of the note plus the value of the stock. And by the way, this 450 is just going to equal the fair market value of what's given up, right? The supplies. That's a good way to check your work. Minus the adjusted basis of the property given up, which we're given here, $300,000. That gives us a realized gain of $150,000. Now, Section 351, remember the requirements. That's a non-recognition rule. You have to have a transfer of property to a corporation. Do we have that here? Yes. We're transferring supplies, cash, to the corporation Mellon Corp. Solely in exchange for stock. Do we have that one? Well, not for Cantaloupe. So we'll put a question mark there and we'll come back. Because if you recall, when we talked about that topic, if you meet requirements 1 and 3, this is requirement 1 and number 3, but you fail number 2, you get partial gain recognition. Number 3 is immediately after the exchange. Such person or persons are in control, which remember is 80% or more. $80 or more. Is that the case here? Yeah, because they formed the business before they own 0, after they own together, 100%. So we meet requirement 1. Number 3, we're only focused on Cantaloupe. Does Cantaloupe fail number 2? Yes. Because Cantaloupe also receives note, which is not considered stock. So if you meet requirement 1 and 3 but fail number 2, you've got the boot rule, right? The boot rule says it's the lesser of the realized gain, which here is, we just calculate $150,000, or the amount of boot, the fair market value of the amount of boot. The boot here is $200,000. So we are going to, oops, that's wrong. We're taking the lesser of those two. The lesser of those two, of course, is $150,000. So the recognized gain is $150,000. So that's not the end of the question, right? That's just the first part. What is the amount of gain recognized? It's $150,000 by Cantaloupe. So now we're going to do the basis. The adjusted basis of property received. So we had a 6-step process when we did this back in Module 6, right? Step 1, 2, and 3 focused on the shareholder, right? Step 1, calculate the gain or loss recognized. Step 2, calculate the basis of the stock. Step 3, holding period. Step 4, gain or loss to the corporation. Step 5, the basis of property of the corporation. Step 6 is the holding period of the property received by the corporation. So we're doing step 1 in this problem and step 5. So step 5 is to get the adjusted basis of the property contributed, which is what the problem is asking. The adjusted basis of supplies. Remember, the general rule is you take the adjusted basis carried over. So we carry that over and we add any gain recognized by the shareholder on that item. So the adjusted basis carried over is, we're told in the problem, if you want to go back you can see. Sorry, let me erase that because we're going to need that space for problem 4. So the adjusted basis carried over is $300,000 in the supplies. Was there any gain recognized by Cantaloupe? Yes. $150,000 of gain. That gives us a basis in the supplies of $450,000. And that is our adjusted basis in the supplies. And it answers both parts of the problem. Problem 4. We've got another Module 6 issue. And this is the one with the courtesy cards. So Module 6, Problem 4, before Variation 1 and 2. Before Variation 1 and 2. So specifically, Lime's recognized gain and the basis of the stock received. That's all I want you to focus on. Just the amount of recognized gain and the basis of stock received. Also assume that Lime contributes $5,000 in cash in addition to the Mercedes-Benz golf cart. So this is something that we're adding to the facts. We're changing it just a little bit. Now, we already saw this, though, because in Variation number 1 and 2, we added in another limo. We had the Lincoln limo. So it's the same concept. So it's the same concept. It's just, okay, this one we're adding in cash. Okay, because on the exam, they're going to have cash in there. So I basically rewrote the question for you. And again, it's the same one. The only difference is Lime also contributes $5,000 of cash. Now remember, this is the problem again where there's liabilities on the golf cart. There's $30,000 liability attached. So the question's asking, what is the recognized gain of transaction to Lime? And what's Lime's basis in the shares of stock in the corporation? So if we go through this problem, we're going to have to do the realized gain and loss calculation like normal because, again, it's a corporate formation problem. You always start with realized gain or loss calculation. So amount realized minus adjusted basis. So the amount realized is what Lime is getting. And we're going to see on the next page how exactly to calculate that. So right here is the calculation, right? Again, we're focusing on Lime. So the amount realized is going to be the value of the stock received plus the liability relief. And you notice the $80,000 equals what or the value of what property Lime's giving up, minus the basis of all property contributed, which is the $5,000 cash and the $10,000 of that's the basis in the limo. We get a realized gain of $65,000. So that's our realized gain. The question is, does Section 351 apply? Well, we meet requirement 1 and 3, just like we saw in the last one. But 2 is questionable. Why is 2 questionable? Because liability relief. Liability relief can only rise to the level of boot in 2 cases. Personal tax avoidance liability, which we don't have here. How do we know that? If you go back and look at the facts, the liability was taken out to acquire the limo. Personal tax avoidance is when you use it for some personal reason like gambling, or you go and buy a house, personal house with taking out the liability. The other one, though, is the excess rule. If the liability exceeds the aggregate adjusted basis of all property contributed, we have to take the excess. This is also known as the Bigfoot rule. So in class, I wear the Bigfoot costume to say you can't have negative basis. That's what this rule is all about. So the idea here is the liability amount is $30,000 on the limo. The basis of all property contributed, which we got here, right, the cash of $5,000 plus the $10,000 basis in the limo is $15,000, right? We add those two together. We subtract the two numbers, and we get an excess of $15,000. So we actually have boot. This equals boot. A boot amount of $15,000. So the rule is, remember, for Section 351, always the lesser of the realized gain, which again is $65,000, and the amount of boot received. So which one's lesser? Of course, $15,000. So $15,000 of gain is recognized by Lime. All right, so that's the first part of the question. The second part of the question is the basis in the stock received by Lime. So the basis formula is always the adjusted basis of old minus any cash received or liability relief received plus gain recognized minus loss recognized, and we get our new basis. So in this problem, we're given the basis of the properties contributed, which is the cash, $5,000, and then the Mercedes-Benz limo is $10,000. We add those together, we get $15,000. Minus the liability relief, which is $30,000, plus the gain recognized, boom, we get 0. So that's the reason why we have to recognize the $15,000 of gain. It's the Bigfoot rule. Because Bigfoot doesn't exist, you can't have negative basis, right? Or I should say, basis, just like Bigfoot doesn't... negative basis, just like Bigfoot, does not exist. So you have to recognize gain to basically make sure that you don't go negative in your basis. So that's why it makes it go to 0. And that is the answer. $15,000 of gain to Lime and 0 basis in the stock. So this is problem 5. This one's very straightforward. Just review module 7. And the main thing is the dividend received deduction. Just remember that these are the rates, right? Depending on your ownership, remember what the dividend received deduction is. You have to be a corporation that owns stock in another corporation. And the idea is it wants to eliminate triple, quadruple taxation. So if you own stock in another corporation, you have to look at your ownership percentage. If you own between 0 and less than 20%, you get a 50% dividend received deduction. If you own 20% equal to 20% to less than 80%, 65%. If you own 80% equal to 80% or more, you get 100%. So you need to know those percentages. So the problem on the exam will be just like this one, with different numbers. So you need to understand how everything fits into the picture. All I'm really going to do is just change around the numbers on the exam. Maybe the ownership percentage as well for the dividend received. So Corporation A has gross income on sales of $7,000 and deductible operating expenses of $9,000. Corporation A owns 80% of Corporation B. Corporation B paid Corporation A a $1,500 dividend. In addition, Corporation A has net capital gain of $3,000. Assume Corporation A and B are both C corporations who do not file consolidated income tax return. Compute Corporation A's taxable income. Okay, whenever you're given a problem with the gross income of sales, and then you're given dividend amount, and then you're also given net capital gain, that means that those amounts of income are all separate. You can't just assume, hey, all three of those numbers all go into the gross, are all in the gross income number. So we first start by calculating, just like any tax return, what the gross income is. Gross income from sales, dividend, capital gain, boom. We add all three of those, we get $11,500. Now we're going to subtract away our operating expenses, our Section 162 trade or business expenses. And here is where the DRD comes into play. So remember, we are going to take our dividend, because this is a Corporation A that owns stock in another corporation. It has to be a C corporation, by the way. I forgot to mention that. That owns stock in another C corporation. So we take the dividend amount. It has to be a dividend. Here it's $1,500. We multiply it by the percentage. Hey, we're told that Corporation A owns 80% of Corporation B, so that's going to be 100%. So that means the DRD of $1,500. So we include $1,500, but then we also get a DRD of $1,500, so effectively it offsets one another, and your taxable income is $1,000. And that is going to be your answer, and taxable income is $1,000. So problem 6 is probably, of the 10 questions, I would say the most challenging. In problem 6, this one, I recommend going back and looking at this problem to get a better understanding. I'm not going to go through every little detail in this problem with you. I'm just going to give you kind of the highlights. I'm also going to show you how I calculated, the proration, just remind you how we do this. But this is a Module 8 discussion problem 3, which is one of the most difficult questions in the entire course. But there is a difference. Assume that, this is the problem where Kiwi and Strawberry, right? Kiwi sells half the shares of stock to Strawberry partway through the year. We'll assume that Kiwi doesn't sell shares of stock. Now, I didn't write this problem. The department did in practice. We would never do this. We would just lump everything together and do it in total. But they want you to do it in pieces. If they ask you for a specific date, and so no sale of stock from Kiwi to Strawberry. So Kiwi owns 100% of the corporation all year. And Kiwi receives 2 distributions, one on April 1st of $40,000 and one on December 31st of $30,000. Okay? That's important. You've got $36,000 of accumulated EMP and you've got $24,000 of current EMP given to you in the problem. What are the tax consequences to Kiwi? So remember distributions, you've got 4 steps. Step 1 and 2, you look at the consequences really to the corporation, you adjust accumulated EMP, you adjust EMP for the year. This is a cash distribution. It's cash, $30,000 and $40,000, $70,000 total, right? Since it's a cash distribution, step 1 and step 2 are, my apologies, step 1 and step 2, there's no consequences. So we go right to step 3. Now, because the problem is just asking for the consequences of the shareholder, Kiwi, we can skip step 4 and just focus on step 3 in this problem, which step 3, unfortunately, though, is the long part. So step 3, remember we had the 4 or 5 subparts of the problem. So the first subpart is to determine the amount of distribution. So the total amount of distribution is a $30,000 the 40,000 distribution plus 30,000 during the year, 70,000 total. Next, we're going to determine how earnings and profits should be allocated. So I've got that on the next page. Finally, then, we go through our waterfall. And we see how we're going to treat the 40,000 and 30,000 received, whether it's going to be a dividend, return of capital, or capital gain. Now, the key to this problem, what they're going to focus on the exam, is I can tell you a date and say how much current E&P is allocated on that date, how much accumulates. So you really have to know the ins and outs. In practice, though, we just kind of lump it all together since it's one owner owns 100%. So this breaks down everything. Here's the analysis of step 2 and step 3. So if you remember in the rules, here's the issue. We've got $70,000 of distributions, and we've got total E&P of $60,000. Now, earnings and profits is positive because we have positive $36,000 in accumulated E&P, and we've got positive $24,000 current E&P. So positive and positive, one owner, normally you just lump it together and boom, we're done, like we did in problem 1. But this problem wants to know the specific dates, how much current and how much accumulated E&P is going to be allocated. That's what the problem is going to focus on. So remember the rules. Because we don't have enough E&P, the rule is first, we allocate current E&P. And how do we allocate current E&P? We do it based on, so we allocate the 24,000 current E&P based on distribution. So here is the allocation. On April 1st, there's a $40,000 distribution. There's $70,000 total during the year. Right? Remember we saw that? On 12/31, it's 30,000 over 70,000 total times 24. So 13,714 of the 24,000 gets allocated to April 1st. 10,286 of the current E&P gets allocated to 12/31. Those add up to the 2. And again, because we're using the pro rata approach based on amount of distributions. The next thing is determining the amount of accumulated E&P. That's second. Accumulated E&P is then allocated based on FIFO. First in, first out, to fill up to get total dividend. So 13,000 of the 13,714 of the 24,000 is allocated on April 1st. The remaining, to get up to 40,000, we take 26,000 of the accumulated, 26,286 of accumulated E&P. We know 10,286 is allocated to current E&P on December 31st. So we have 9,000 left because we don't have enough to cover it of the accumulated E&P. And that's how you do this calculation. Okay? The question is going to ask you how much current E&P on a specific date is allocated, how much accumulated E&P, and that's what you need to focus on. All right, so problem 7 is just like module 9 discussion problem 2. Same exact question. It's just going to focus, though, on the gain that U-Pick Fruit Corporation has. So I went ahead and I rewrote the problem for you. It's right here. We're just going to focus on the gain to U-Pick Fruit Corp. This is a liquidation problem, right? Module 9 problem 2C is liquidation problem. This is the one with Berry Acre, right? So remember, we're just looking at the consequences to the corporation. The gain or loss to the corporation. Amount realized minus adjusted basis. Now, it's not the special rule that applies for liquidation, right? It's a liquidation problem because we're told that the corporation liquidates. It's not the special rule. Why? Because Strawberry is an individual. I'm sorry. We don't know Strawberry is an individual, but we know that nobody owns 80% or more. That's the special rule. So the general rule applies of liquidation. So the corporation is going to have to recognize gain or loss. So what we do is we look at, hey, what is U-Pick Fruit getting? Well, on liquidation, what we do is we do the greater of the fair market value or any liability relief. So the fair market value of property being distributed out, well, there's cash of $2 million and there's Berry Acre. Now, we can ignore the cash. Why? Technically, to calculate the gain or loss, you got to put that in there. But we can really ignore it. Why? Because the basis of the cash and the face value of the cash will equal, so they're going to always net to 0 when you're calculating gain. So you can just pretty much ignore that part of the problem. And you'll still get the same answer. If you did put it in there, which is a more formal, proper way, you'd be fine. So we're just going to focus on Berry Acre. So the fair market value of Berry Acre is $10 million. It's the greater of that or the liability relief that the corporation has, which is $11 million. So what's greater, 10 million or 11 million? Of course, it's the 11 million. So the amount realized is going to be 11 million minus the adjusted basis of the property given up. But again, we're ignoring the cash because we're not putting that in there. So we're just going to go right to the basis of Berry Acre, which is $3 million. So we subtract away 3 million. So that gives us $8 million of gain, and that's all the question is asking, and that's all you have to do. So again, you can pretty much ignore cash because cash, if you put in cash, it'd be 13 million with the cash, 2 million cash plus 11 million minus 5 million, so it'd also be $8 million as well. It would be the same thing. But the idea is that the cash is going to be the face value of the cash and the basis are equal, so they offset. So we're just focusing on here Berry Acre, which is what creates the potential for gain or loss. Everyone see that? So we just focus on that element right there. So then we have problems 8, 9, and 10. Problem 8, 9, and 10. This actually is module, so number 8. This is actually module 10, formation operations, problem 5. So it's just like the one. I have a video on this one already. You can go ahead and review that video. It goes through it. It's the pre-contribution gain or loss, right, with the step 1, step 2 analysis. You can watch that video. Number 9 is just like module 10 formation discussion problem 6. That's problem 6. So you can watch that video as well. The only difference is that I renamed the parties in those videos for fruit, for the parties for the fruit. And then problem 10, this one comes from module 11, supplemental readings. And basically what this one is it focuses on the S Corporation supplemental materials and the basics, the video. So remember that S corporations have certain requirements. You can only have 100 or fewer owners. You can only have one type of stock, remember, for S corporations. You can't have entities that own S corporations, and they can't be non-resident owners, alien owners. And then remember, only certain entities are eligible to be S corporations. So if you know that, you'll be good for that question right there. So that really concludes all of these, the 10 problems.